There's one more person I would like to introduce to you today, and I'm quite sure he's here. I haven't seen him, but I understood he was coming, and that is Jack Bogle, who I talked about in the annual report. Jack Bogle has probably done more for the American investor than any man in the country. Jack, could you stand up? There he is. Jack Bogle, many years ago, he wasn't the only one that was talking about an index fund, but it wouldn't have happened without him. I mean, Paul Samuelson talked about it. Ben Graham even talked about it. But the truth is, it was not in the interest of the investment industry of Wall Street. It was not in their interest, actually, to have the development of an index fund, the index fund, because it brought down fees dramatically. And as we've talked about some in the reports and other people have commented, index funds overall have delivered for shareholders a result that has been better than Wall Street professionals as a whole. And part of the reason for that is that they brought down the costs very significantly. So when Jack started, very few people, certainly Wall Street, did not applaud him. And he was the subject of some derision and a lot of attacks. And now we're talking trillions when we get into index funds. And we're talking a few basis points when we talk about investment fees in the case of index funds, but still hundreds of basis points when we talk about fees elsewhere. And I estimate that Jack, at a minimum, has left in the pockets of investors without hurting them overall in terms of performance at all, gross performance. He's put tens and tens and tens of billions into their pockets, and those numbers are going to be hundreds and hundreds of billions over time. So it's Jack's 88th birthday on Monday. So I just say happy birthday, Jack, and thank you on behalf of American investors. And Jack, I've got great news for you. You're going to be 88 on Monday, and in only 2 years you'll be eligible for an executive position at Berkshire. So hang in there, buddy. Okay.
Hi, Warren and Charlie. My name is Brian Martin, and I'm from Springfield, Illinois. In the HBO documentary, Becoming Warren Buffett, you had a great analogy comparing investing to hitting a baseball and knowing your sweet spot. Ted Williams knew his sweet spot was a pitch right down the middle. When both of you look at potential investments, what attributes make a company a pitch in your sweet spot that you'll take a swing at and invest in?
Well, I'm not sure I can define it in exactly the terms you would like, but we sort of know it when we see it, and it would tend to be a business that, for one reason or another, we can look out 5 or 10 or 20 years and decide that the competitive advantage that it had at the present would last over that period, and it would have a trusted manager that would not only fit into the Berkshire culture, but that was eager to join the Berkshire culture. And then it would be a matter of price. But the main, when we buy a business, essentially we're laying out a lot of money now based on what we think that business will deliver over time. And the higher the certainty with which we make that prediction, the better we feel about it. You can go back to the first, wasn't the first outstanding business we bought, but it was kind of a watershed event, which was a relatively small company, See's Candy. And the question when we looked at See's Candy in 1972 was, would people still want to be both eating and giving away that candy in preference to other candies. And it wouldn't be a question of people buying candy for the low bid. And we had a manager we liked very much, and we bought a business that was paid $25 million for it net of cash, and it was earning about $4 million pre-tax then, and we must be getting close to $2 billion or something like that pre-tax that we've taken out of it. But it was only because we felt that people would not be buying necessarily a lower price candy. I mean, it does not work very well if you go to your wife or your girlfriend on Valentine's Day. I hope they're the same person, and say, here's a box of candy, honey. I took the low bid. It doesn't. It loses a little as you go through that speech. And we made a judgment about See's candy that it would be special, and probably not in the year 2017, but we certainly thought it would be special in 1982 and 1992, and fortunately we were right on it. And we're looking for more See's candies, only a lot bigger. Charlie?
Yeah, but it's also true that we were young and ignorant then. And
now we're old and ignorant. Yeah.
Yes, that's true too. And the truth of the matter is that it would have been very wise to buy See's candy at a slightly higher price. And if they'd asked it, we wouldn't have done it. So we've gotten a lot of credit for being smarter than we were.
Yeah, and to be more accurate, if it had been $5 million more, I wouldn't have bought it. Charlie would have been willing to buy it. So fortunately, that we didn't get to the point where we had to make that decision that way. But he would have pushed forward when I probably would have faded. It's a good thing. It's a good thing that the guy came around. Actually, the seller was the grandson of Mrs. C, wasn't he, Charlie? He was Larry C's son. Am I correct? Or Larry C's brother. But he was not interested in the business, and he was more interested in girls and grapes, actually. And he almost changed his mind. He did change his mind about selling, and I wasn't there, but Rick Aaron told me that Charlie went in and gave an hour talk on the merits of girls and grapes over having a candy company. This is true, folks. And the fellow sold to us, so that I pulled Charlie out in emergencies like that.
We were very lucky that early the habit of buying horrible businesses because they were really cheap. It gave us a lot of experience trying to fix unfixable businesses as they headed downward toward doom. And that early experience was so horrible, fixing the unfixable, that we were very good at avoiding it thereafter. So I would argue that our early stupidity helped us.
Yeah. We learned we could not make a silk purse out of a sow's ear.
No, we learned.
So we went around looking for silk.
But you have to try it for a long time and fail and have your nose rubbed in it to really understand it.
Okay, Becky.
This question comes from a shareholder named Mark Blackley in Tulsa, Oklahoma, who says, there has been more news than usual in some of Berkshire's core stock holdings, Wells Fargo and the incentive and new account scandal, American Express losing the Costco relationship and playing catch-up in the premium card space, United Airlines and customer service issues, Coca-Cola and slowing soda consumption. How much time is spent reviewing Berkshire stock holdings, and is it safe to assume if Berkshire continues to hold these stocks that the thesis remains intact?
Well, we spend a lot of time thinking. Those are very large holdings. If you add up American Express, Coca-Cola, and Wells Fargo, I mean, you're getting up, well into the high tens of billions of dollars, and those are businesses we like very much. They're different characteristics. In the case of, you mentioned United Airlines, we actually are the largest holder of all four of the large. We're the largest holder of the four largest airlines, and that is much more of an industry thought. But all businesses have have problems, and some of them have some very big pluses. I personally, you mentioned American Express. If you read American Express's first quarter report and talk about their Platinum card, the Platinum card is doing very well. The gains around the world, I think there were 17% or something like that in billings in the UK, and 15% is the original currency, or the local currency, Japan, Mexico, and very good in the United States. There's competition in all these businesses. If we thought we did not buy American Express or Wells Fargo or United Airlines, but Coca-Cola with the idea that they would never have problems or never have competition. Why we did buy them is we thought they had very, very strong hands, and we liked the financial policies in the case of many of them. We like their position. We bought a lot of businesses, and we do look to see where we think they have durable competitive advantage, and we recognize that if you've got a very good business, you're going to have plenty of competitors who are going to try and take it away from you, and then you make a judgment as to the ability of your particular company and product and management to ward off competitors. They won't go away, but we think, I'm not going to get into the specific names on it, but those companies generally are very well positioned. I've likened essentially, if you've got a wonderful business, even if it's a small one like See's Candy, you basically have an economic castle, and in capitalism, people are going to try and take away that castle from you. So you want a moat around it, protecting it in various ways that can protect it. And then you want a knight in the castle that's pretty darn good at warding off marauders. But they're going to be marauders, and they'll never go away. And if you look at, I think Coca-Cola was 1886, American Express was 51 or 52, starting out with an express business. Wells Fargo with, I don't know what year they were started. Incidentally, American Express was started by Wells and Fargo as well. So these companies had lots of challenges, and they'll have more challenges, and the companies we own have had challenges. Our insurance business has had challenges, but we started with National Indemnity as $8 million purchase in 1968, and fortunately we've had people like Tony Nicely at Geico, and we've had G. Jane, who's added tens of billions of value, and we've got some smaller companies that you probably don't even know about, but really have done a terrific job for us. So there'll always be competition in insurance, but there'll always be things to do that a really intelligent management with a decent distribution system, various things going for them, can do to ward off the marauders. So to the specific question, how much time is spent reviewing the holdings, I would say that I do it every day. I'm sure Charlie does it every day. Charlie?
Well, I don't think I got anything to add to that either.
Well, we'll cut his salary if he doesn't participate here. Okay, Jay Gelb.
In your career of thousands of negotiations and business dealings, could you describe for the crowd which one sticks out in your mind as your favorite, or as which one sticks out in your mind as your favorite, or is otherwise noteworthy?
Well, I don't think I've got a favorite, but the one that probably did us the most good as a learning experience was See's Candy. It just, the power of the brand, the unending flow of ever-increasing money with no work.
Sounds nice.
It was, and I'm not sure we would have bought the Coca-Cola if we hadn't bought the Seas. I think that a life properly lived is just learn all the time. And I think Berkshire's gained enormously from these investment decisions by learning through a long, long period. Every time you appoint a new person that's never had big capital allocation experience, it's like rolling the dice. And I think we're way better off having done it so long. But the decisions blend. And the one feature that comes through is the continuous learning. If we had not kept learning, you wouldn't even be here. You'd be alive probably, but not here.
There's nothing like the pain of being in a lousy business to make you appreciate a good one.
Well, there's nothing like getting into a really good one. That's a very pleasant experience, and it's a learning experience. I have a friend who says, the first rule of fishing is to fish where the fish are. And the second rule of fishing is to never forget the first rule. And we've gotten good at fishing where the fish are.
Yeah, that's only metaphorically. I went to fish with Charlie one time.
There are too many other boats in the damn water, but the fish are still there.
Yeah, we bought a department store in Baltimore in 1966, and there's really nothing like being in the experience of trying to decide whether you're going to put a new store in a area that hasn't really developed yet enough to support it, but your competitor may move there first, and then you have the decision of whether to jump in, and if you jump in, that kind of spoils it. Now you got two stores where even one store isn't quite justified. How to play those games, those business games, is you learn a lot by trying, and what you really learn is which ones to avoid. I mean, if you just stay out of a bunch of terrible businesses, you're off to a very great start, because we've tried them all.
But you can really learn because the experience is a lot like eating cockleburgers, and it really gets your attention.
Well, we won't expand on that. Andrew Ross Sorkin.
Good morning, Warren. This question comes from a longtime shareholder who, I should tell you, accosted me last night in the lobby of the Hilton Hotel with this question. Warren, for years you stayed away from technology companies, saying they were too hard to predict and didn't have moats. Then you seemed to change your view about technology when you invested in IBM, and again when you recently invested in Apple. But then on Friday you said IBM had not met your expectations and sold a third of our stake. Do you view IBM and Apple differently? And what have you learned about investing in technology companies?
Well, I do view them differently, but obviously, when I bought the IBM, started buying it 6 years ago, I thought it would do better in the 6 years that have elapsed than it has. And Apple, I regard them as being a quite different business. I think Apple is much more of a consumer products business in terms of in terms of sort of analyzing moats around it and consumer behavior and all that sort of thing. It's obviously a product with all kinds of tech built into it, but in terms of laying out what their prospective customers will do in the future as opposed to, say, on IBM's customers, it's a different sort of analysis. That doesn't mean it's correct, and we'll find out over time, but they are two different types of decisions, and I was wrong on the first one, and we'll find out whether I'm right or wrong on the second. But I do not regard them as apples and apples, and I don't quite regard them as apples and oranges, but it's somewhat in between on that. Charlie?
Well, we avoided the tech stocks because we felt we had no advantage there and other people did. And I think that's a good idea, not to play where the other people are better. But if you asked me in retrospect what was our worst mistake in the tech field, I think we were smart enough to figure out Google. Those ads worked so much better in the early days than anything else. So I would say that we failed you there. And we were smart enough to do it and didn't do it. We do that all the time, too.
Yeah, we were their customer very early on with Geico, for example, and we saw. I don't. These figures are way out of date, but as I remember, we were paying them $10 or $11 a click or something like that. And anytime you're paying somebody $10 or $11 every time somebody just punches a little thing where you've got no cost at all, that's a good business unless somebody's going to take it away from you. And so we were close up seeing the impact of that. And incidentally, if any of you don't have anything to do in your hotel rooms tonight, just keep punching Progressive or something, and you're gonna don't really do that. The thought just happened to cross my mind. But that is, you've never seen a business, almost never seen a business like it, where and I think for LASIK surgery and things like that, I think the figures were, $60 or $70 a click with no incremental, no cost. So, and I knew the guys. I mean, they actually designed their prospectus. They came to see me, and a little bit after the original one, when they went public, a little bit after Berkshire even. And so I had plenty of ways to ask questions or anything of the sort, educate myself, but I blew it. And
we blew Walmart too. When it was a total cinch, we were smart enough to figure that out, and we didn't.
Yeah. Figuring out execution is what counts. So, anyway, well, and I could be making two mistakes on IBM. I mean, it's harder to predict, in my view, the winners in various items, or how much price competition will enter in to something like cloud services and all that. I made a statement the other day, which it's really remarkable, and I asked Charlie whether he could think of a situation like it, where one person has built an extraordinary economic machine in two really pretty different industries, almost simultaneously, as has happened.
From a standing start at zero.
From a standing start at zero, with competitors with lots of capital and everything else, to do it in retailing and to do it with the cloud, like Jeff Bezos has done. I mean, I mean, people like the Mellons invested in a lot of different industries and all of that, but he has been in effect the CEO simultaneously of two businesses starting from scratch. That if Andy Grove at Intel used to say, think about if you had a silver bullet and you could shoot it and get rid of one of your competitors, who would it be? Well, I think that both in the cloud and in retail, there are a lot of people that would aim that silver bullet at Jeff, and he's done it's a different sort of game. But he's, at the Washington Post, he's played that hand as well as anybody I think possibly could. So it's a remarkable business achievement where he's been involved actually in the execution, not just bankrolling it, of two businesses that are probably as feared by their competitors almost as any you can find. Charlie, you got further thoughts?
Well, we're sort of like the Mellons, old-fashioned people who've done all right. And Jeff Bezos is a different species.
And we missed it entirely, incidentally. We never owned a share of Amazon. Okay, Greg Warren.
This question is from Franz Tromberger of Austria, and it concerns intrinsic value, which is neither, Warren he may amend my definition here, but which is neither a company's accounting value nor its stock market value, but is rather its estimated real value. So the question is, at what rate has Berkshire compounded intrinsic value over the last 10 years, and at what rate, including your explanation for it, please, do you think intrinsic value can be compounded over the next 10 years?
Yeah. Intrinsic value, can only be calculated or gains, in retrospect. But the intrinsic value, pure definition, would be the cash to be generated between now and Judgment Day, discounted at an interest rate that seems appropriate at the time, and that's varied enormously over a 30 or 40 year period. If you pick out 10 years and you're back to May of 2007, we had some unpleasant things coming up, but I would say that we've probably compounded at about 10%, and I think that's going to be tough to achieve, in fact, almost impossible to achieve if we continued in this interest rate environment. That's the number one question. If you ask me to give the answer to the question, if I could only pick one statistic to ask you about the future before I gave the answer, I would not ask you about GDP growth. I would not ask you about who was going to be president. A million things. I would ask you what the interest rate is going to be over the next 20 years on average, the 10-year or whatever you wanted to do. And if you assume our present interest rate structure is likely to be the average over 10 or 20 years, then I would say it'd be very difficult to get to 10%. On the other hand, if I were to pick with a whole range of probabilities on interest rates, I would say that rate might be it might be somewhat aspirational, and it might be doable. And you would say, well, we can't continue these interest rates for a long time. I would ask you to look at Japan, where 25 years ago we couldn't see how their interest rates could be sustained, and we're still looking at the same thing. So I do not think it's easy to predict the course of interest rates at all. And unfortunately, predicting that is embedded in giving a good answer to you. I would say the chances of getting a terrible result in Berkshire are probably as low as about anything you can find. Chances of getting a sensational result are also about as low as anything you can find. So if my best guess would be in the 10% range, but that assumes somewhat higher interest rates, not dramatically higher, but somewhat higher interest rates in the next 10 or 20 years than we've experienced in the last 7 years. Charlie?
Well, there's no question about the fact that the future with our present size is, in terms of percentage rates of return, is going to be less glorious than our past. And we keep saying that, and now we're proving it.
Do you want to end on that note, Charlie, or would you care to?
Well, I do think Warren's right about one thing. I think we have a collection of businesses that, on average, has better investment values than, say, the S&P average. So I don't think you shareholders have a terrible problem.
And I would say we probably, well, I'm certain, we do have more of a shareholder orientation than the S&P 500 as a whole. I mean, this company has a culture where decisions are made as an owner, as a private owner would make them, and frankly, that's a luxury we have that many companies don't have. I mean, they are under pressures today sometimes to do things. One of the questions I asked the CEO of every public company that I meet is, what would you be doing differently if you owned it all yourself? And the answer, is usually this, that, and a couple of other things. If you would ask us, the answer is we're doing exactly what we would do if we owned them all the stock ourselves. And I think that's a small plus over time. Anything further, Charlie?
I think we have one other advantage. A lot of other people are trying to be brilliant, and we're just trying to stay rational. And it's a big advantage. Trying to be brilliant is dangerous, particularly when you're gambling.
Okay, Jonathan.
Charlie, in that response, said that he thinks the Berkshire's businesses on the whole will do better than the S&P 500. Clark Cameron from Birmingham, Alabama, who owns 281 shares of Berkshire B, writes in and asks, Why have you advised your wife to invest in index funds after your death rather than Berkshire Hathaway? I believe Munger has counseled his offspring to, quote, not be so dumb as to sell.
Yeah. She won't be selling any Berkshire to buy the index funds. All of my Berkshire, every single share, will go to philanthropy. So that I don't even regard myself as owning Berkshire. Basically, it's committed, and so far about 40% has already been distributed. So the question is, somebody who is not an investment professional will be, I hope, reasonably elderly by the time that the estate gets settled. And what is the best investment, meaning one that there would be less worry of any kind connected with, and less people coming around and saying, why don't you sell this and do something else and all those things. She's going to have more money than she needs. And the big thing then you want is money not to be a problem. And there will be no way that if she holds the S&P, or virtually no way, absent something happened with weapons of mass destruction, but virtually no way that she'll have all the money that she possibly can use. She'll have a little liquid money so that if stocks are down tremendously at some point, they close the stock exchange for a while, anything like that, she'll still feel that she's got plenty of money. And the object is not to maximize. It doesn't make any difference whether the amount she gets doubles or triples or anything of the sort. The important thing is that she never worries about money the rest of her life. And I had an Aunt Katie here in Omaha, who Charlie knew well, and worked for her husband, as did I. And she worked very hard all her life and had lived in a house she paid, $8,000 for at 45th and Hickory all her life. And because she was in Berkshire, she lived to 97. She ended up with, a few $100 million. And she would write me a letter every 4 or 5 months, and she said, "Dear Warren, I hate to bother you, but am I going to run out of money?" And and I would write her back, and I'd say, "Dear Katie, it's a good question, because if you live 986 years, you're going to run out of money." And then about 4 or 5 months later, she'd write me the same letter again. And I have seen there's no way in the world, if you've got plenty of money, that it should become a minus in your life. And there will be people, if you've got a lot of money, that come around with various suggestions for you, sometimes well-meaning, sometimes not so well-meaning. So if you've got something that's certain to deliver, it was all in Berkshire, they'd say, well, if Warren was alive today, he would be telling you to do this. I just don't want anybody to go through that. And the S&P will be I think actually what I'm suggesting is what a very high percentage of people should do something like that. And I don't think they will have I think there's a chance they won't have as much peace of mind if they own one stock and they've got neighbors and friends and relatives that are trying to do some, like I say, sometimes well-intentioned, sometimes otherwise, to do something else. And so I think it's a policy that will get a good result and is likely to stick. Charlie?
Well, as Becky said, the Mungers are different. I want them to hold the Berkshire.
Well, I want to hold the Berkshire too.
No, I don't like the. I recognize the logic of the fact that S&P algorithm is very hard to beat. In a diversified portfolio of big companies, it's all but impossible for most people. But I'm just more comfortable with the Berkshire.
Well, it's the family business.
Yeah.
But I've seen too many people as they get older, particularly being susceptible and just having to listen to the arguments of people coming along.
Well, if you're going to protect your heirs from the stupidity of others, you may have some good system, but I'm not much interested in that subject.
Okay.
My company, AI Holdings, is spreading value investing philosophy in Asia. My business partner Ken Chi, Zhou Guiying, and I are committed to awake 100 million Chinese people to return to rational way of investing. The hardest thing in this world is to change people's values or belief system. And we should like to awake investors to change from speculate in the market to investing in the market. It's like changing the speculators' values or belief system. May I ask you, Mr. Buffett, can you kindly advise us what we should do to spread your value investing philosophy, or is there any word of encouragement? Thank you.
Yeah, when in any system, Keynes wrote about this in 1936, I think it was, in the General Theory, or 35, I think it's chapter 12. It's great chapter on investing, and he talked about investment and speculation and the propensity of people to speculate and the dangers of it, and worded eloquently. There's always the possibility of, there's always some speculation, obviously, and there's always some value investors and all of that sort of thing in the market. But when speculation gets rampant, and when you're getting what I guess Charlie would call social proof that it's worked recently, people can get very excited about speculating in markets, and we will have it from time to time in this market. There's nothing more agonizing than to see your neighbor, who you think has an IQ about 30 points below you, getting richer than you are by buying stocks, and whether it's internet stocks or whatever, and people succumb to it, and they'll succumb in this economy just as elsewhere. There's also a point which gets to your question. I would say that early on in the development of markets, there's probably there's some tendency for them, I think, to be more speculative than markets that have been around for a couple of hundred years. Because markets have a casino characteristic that has a lot of appeal to people, particularly when they see, like I say, people getting rich around them. And those who haven't been through cycles before are probably a little more prone to speculate than people who have experienced the outcome of wild speculation. So basically in this country, Ben Graham was, in the book I read in 1949, was preaching investment, and that book continues to sell very well. But if the market gets hot, new issues are doing well, and people on leverage are doing well, a lot of people will be attracted to not only speculation but what I would call gambling. And I'm afraid that will be true in the United States. And I think that China, being a newer market, essentially, in which there's widespread participation, is likely to have some pretty extreme experiences in that respect. We will have some in this country too. Charlie? Well, I certainly agree with that. The Chinese will have more trouble. They're very bright people. They have a lot of action, and sure, they're going to be more speculative. And it's a dumb idea. And to the extent you're working on it, why, you're on the side of the angels, but lots of luck. Well, it will offer the investor more opportunities, actually, if they can keep their wits about them. If you have wild speculation, Charlie just mentioned earlier, if we get into periods that are very tough, Berkshire certainly will do reasonably well, because we won't get fearful, and fear spreads like you cannot believe until you've seen a few examples of it. At the start of September 2008, you had 35 million people with their money in money market funds with $3.5 trillion in them, and none of them were afraid that that dollar wasn't going to be a dollar when they went to cash in their money market fund. And 3 weeks later, they were all terrified, and 175 billion flowed out in 3 days. And so the way the public can react is really extreme in markets. And that actually offers opportunities for investors. People like action and they like to gamble. And if they think there's easy money to be made, a lot of them, you'll get a rush to it. And for a while, it will be self-fulfilling and create new converts until the day of reckoning comes. So just keep preaching, investing, and if the market swings around a lot, you'll keep adding a few people here and there to a group that recognizes that markets are there to be taken advantage of rather than to instruct you as to what is going on. Okay, Andrew, do you have any more on that, Charlie?
We've done a lot of preaching, Warren, without much effect.
Right. And that's probably good from our standpoint. But, okay, Andrew?
I'm from Shankar Anand from Gurnee, Illinois. Thank you for doing everything you do for us. I have a question. The two of you have largely avoided capital allocation mistakes by bouncing ideas off of one another. Will this continue long into Berkshire's future? And I'm interested in both at headquarters and at subsidiaries.
It can't continue very long.
Don't get defeatist, Charlie. Any successor that's put in at Berkshire, capital allocation abilities and proven capital allocation abilities are certain to be uppermost in the board's minds, or in the current case, in terms of my recommendation, Charlie's recommendation, for what happens after we're not around. Capital allocation is incredibly important at Berkshire. Right now we have 280 or 90 billion, whatever it may be, of shareholders' equity. If you take the next decade alone, nobody can make accurate predictions on this, but in the next 10 years, if you just take and depreciation right now is another $7 billion a year, something on that order. The next manager in the decade is going to have to allocate maybe $400 billion or something like that, maybe more, and it's more than already has been put in. So 10 years from now, Berkshire will be an aggregation of businesses where more money has been put in that decade than everything that took place ahead of time. So you need a very sensible capital allocator in the job of being CEO of Berkshire, and we will have one. It would be a terrible mistake to have someone in this job where really capital allocation might even be their main talent. It probably should be very close to their main talent. And of course, we have an advantage at Berkshire in that we do know how important that is, and there is that focus on it. And in a great many companies, people get to the top through ability and sales. Sometimes they come from the legal side, sometimes all different sides, and they then have the capital allocation sort of in their hands. Now, they may not establish strategic thinking divisions, and they may listen to investment bankers and everything, but they better be able to do it themselves. And if they've come from a different background or haven't done it, it's a little bit, as I put in one of my letters, I think it's like getting to Carnegie Hall, playing the violin, and then you walk out on the stage and they hand you a piano. I mean, it is something that Berkshire would not do well if somebody was put in who had a lot of skills in other areas, but really did not have an ability of capital allocation. I've talked about it as being something I call a money mind. I mean, people can have 120 IQs or 140 IQs or whatever it may be, very similar scoring abilities in terms of intelligence tests, and some of them have minds that are good at one type of thing and some of them another. I've known very bright people that do not have money minds, and they can make very unintelligent decisions. They can do all kinds of other things that most mortals can't do, but it just isn't the way their wiring works. And I've known other people that really would not do that brilliantly. They do fine, but on an SAT test or something like that. But they've never made a dumb money decision in their life. And Charlie, I'm sure, has seen the same thing. So we do want somebody, and hopefully they've got a lot of talents, but we certainly do not want somebody that, if they lack a money mind. Charlie?
Well, there's also the option of buying in stock, so it isn't like it's some hopeless problem. One way or another, something intelligent will be done.
And a money mind will recognize when it makes sense to buy in stock and doesn't. And in fact, it's a pretty good test for some people in terms of managements, how they think about something like buying in stock, because it's not a very complicated equation if you sort of think straight about that sort of a subject. But some people think that way and some don't, and they're probably miles better at something else. But they say some very silly things when you get to something that seems so clear as whether, say, buying in stock makes sense.
This question is on Berkshire's intrinsic value. A substantial portion of the company's value is driven by operating businesses rather than the performance of the securities portfolio. Also, the values of previously acquired businesses are not marked up to their economic value, including Geico, Mid-American, and Burlington Northern. Based on these factors, is book value per share still a relevant metric for valuing Berkshire?
Well, it's got some relevance, but it's got a whole lot less relevance than it used to, and that's why I don't want to drop the book value per share factor, but the market value tends to have more significance as the decades roll along. It's a starting point, and clearly our securities aren't worth more than we're carrying them for at that time. And on the other hand, we've got the kind of businesses you mentioned, but we've got some small businesses that are worth 10 times or so, what would they're carried for. We've also got some clunkers too. But I think the best method, of course, is just to calculate intrinsic business value, but it can't be precise. We know, we think the probability is exceptionally high that 120% understates it. Although if it was all in securities, 120% would be too high. But as the businesses have evolved, as we built in unrecognized value at the operating businesses, unrecognized for accounting purposes, I think it still has some use as being kind of the base figure we use. If it were a private company and 10 of us here owned it, instead we just sit down annually and calculate the businesses one by one and use that as a base value. But that gets pretty subjective when you get as many as we do. And so I think the easiest thing is to use the standards we're using now, recognizing the limitations in them. Charlie?
Yeah, I think that equities in an insurance company offsetting shareholders' equity in the company are really not worth the full market value because they're locked away in a high-tax system. And so I basically like it when our marketable securities go down and our own businesses go up.
Yeah, we're working to that end. We've been working that way for 30 years now or something like that.
We've done a pretty good job, too.
Yeah.
We have a lot of We've replaced a lot of marketable securities with unmarketable securities that are worth a lot more.
Yeah, and it's actually a more enjoyable way to operate too, beyond that. But,
Yeah, we know a lot of people we wouldn't otherwise
yeah.
be with. Good people.
Okay, station 3.
One of your most well-known pieces of investment advice is to buy what you know. Additionally, you said earlier, one of the main criteria for buying is if you could ever understand the business. Ever since I came to my first meeting in 2011, you were not known for being a tech guy. You have said smartphones are too smart for you, you don't have a computer at your desk, and you've only tweeted 9 times in the last 4 years.
It was either that or going to a monastery.
Despite this, you've recently been investing, looking, and talking more about tech companies. My question to you, and also to Charlie to comment, is what turned you from the Oracle of Omaha to the tech maven of Omaha?
Well, I don't think I would. I don't think I've talked that much about tech companies, but the truth is we made a large investment in IBM. I made a large investment in IBM, which has not turned out that well. We haven't lost money, but in terms of the bull market we've been in, it's been a significant laggard. And then fairly recently, we took a large position in Apple, which I do regard as more of a consumer goods company in terms of certain economic characteristics, although that it has a huge tech component in terms of what that product can do or what other people might come along to do to leapfrog it in some way. But I think I'll end up being, no guarantees, but I think I'll end up being 1 for 2 instead of 0 for 2, but we'll find out. Charlie, I make no pretense whatsoever of being on the intellectual level of some 15-year-old that's got an interest in tech. I think I may have some insights into consumer behavior. I certainly can get a lot of information on consumer behavior and then try to draw inferences about what that means about what consumer behavior is likely to be in the future. But we will find the other thing I'll guarantee is I'll make some mistakes on marketable securities, and I've made them in other areas than tech. So you'll not bat 1,000, no matter what industries you try to stick with. I know insurance pretty well, but I think we probably lost money on an insurance stock, perhaps, once or twice over the years. So you don't bat 1,000. But I have gained no real knowledge about tech in the last, since I was born, actually. Charlie?
I think it's a very good sign that you bought the Apple. It shows either one of two things. Either you've gone crazy or you're learning. I prefer the learning explanation.
Well, so do I, actually.
Hi, Warren. This one's a fun one. Thomas Kamei is here. He's a 27-year-old shareholder from Kentfield, California. And I should preface this question by saying that he was here 17 years ago, at 10 years old, asked you a question from the audience, asking you if the internet might hurt some of Berkshire's investments. At the time, you said you wanted to see how things would play out. He's now updated the question. What do you think about the implications of artificial intelligence on Berkshire's businesses beyond autonomous driving and Geico, which you've talked about already? In your conversations with Bill Gates, have you thought through which other businesses will be most impacted? And do you think Berkshire's current businesses will have significantly more or less employees a decade from now as a function of artificial intelligence?
Well,
we mixed a couple questions together.
Yeah. I certainly have no special insights on artificial intelligence, but I will bet a lot of things happen in that field in the next couple of decades and probably a shorter time frame. They should lead, I would certainly think, but again, I don't bring much to this party, but I would certainly think they would result in significantly less employment in certain areas, but that's good for society. And it may not be good for a given business, but let's take it to the extreme. Let's assume one person could push a button and essentially, through various machines, robotics, all kinds of things, turn out all of the output we have in this country. So there's just as much output as we have. It's all being done by, instead of 150 some million people being employed, one person. Is the world better off or not? Well, it certainly would involve less hours a week of work per week and so on. I mean, it would be a good thing, but it would require enormous transformation in how people relate to each other, what they expect of government, all kinds of things. And of course, as a practical matter, more than one person would keep working. But pushing the idea that way is one of the, you'd certainly think that's one of the consequences of making great progress in artificial intelligence. And that's enormously pro-social eventually. It's enormously disruptive in other ways, and it can have huge problems in terms of a democracy and how it reacts to that. It's similar to the problem we have in trade, where trade is beneficial to society, but the people that see the benefits day by day of trade don't see a price at Walmart on socks or whatever they're importing that says, you're paying X, but you would pay X plus so many cents if you bought this domestically. So they're getting these small benefits and invisible benefits, and the guy that gets hurt by it, who's the roadkill of free trade, feels it very specifically, and that translates into politics. And so it gets very uncertain as to how the world would adjust, in my view, to great increases in productivity. And without knowing a thing about it, I would think that artificial intelligence would have that hugely beneficial social effect, but a very unpredictable political effect if it came in fast, which I think it could. Charlie?
Well, you're painting a very funny world where everybody's engaged in trade, and the trade is I give you golf lessons and you dye my hair. And that would be a world kind of like the royal family of Kuwait or something. And I don't think it would be good for America to have everything produced by one person and the rest of us just engaged in leisure.
How about if we just got twice as productive?
What?
How about if we got twice as productive in a short period of time so that 75 million people could do what 150 million people are doing now?
I think you'd be amazed how quickly people would react to that.
In what way?
Favorably. That's what happened during the period when everybody remembers with such affection, back in the Eisenhower years, 5% a year or something. People loved it. Nobody complained that they were getting air conditioning and they didn't have it before. Nobody wanted to go back to stinking, sweating nights in the South.
Well, if you cut everybody's hours in half, it's one thing. But if you fire half the people and the other people keep working, I just think it gets very unpredictable. I mean, I think we saw some of that in this election because I think that.
Well, we've adjusted to an enormous amount of it. It just came along a few percent per year.
Well, and the question then is,
I don't think you have to worry about it coming out of 25% a year. I think you have to worry about it. You're going to get less than 2% a year. That's what's worrisome.
Okay, we'll move on. But it will be, it's an absolutely fascinating subject to see what happens with this, but it gets very, very hard to predict. If in some way, we've got 36,000 people, say, employed at Geico, and if you could do the same, perform all the same functions, or virtually all the same functions even, and do it with 5,000 or 10,000 people, and it came on quickly, and the same thing was happening in a great many other areas. I don't think we've ever experienced anything quite like that, and maybe we won't experience anything like it in the future. I don't know that much about AI, but
I don't think you have to worry about that.
Well, that's because I'm 86.
It's not going to come that quickly.
Okay, Greg.
Hi, my name is Joey, and I'm an MBA candidate at Wharton. Thank you for having us. Amazon has been hugely disruptive due to the brilliance of Jeff Bezos, whom Charlie earlier called the business mind of our generation. What is your current outlook on Amazon, and why hasn't Berkshire bought in?
Well, because I was too dumb to realize what was going to happen. Even though I admired Jeff, I've admired him for a long, long time and watched what he was doing, but I did not think that he could succeed on the scale he has, and I certainly didn't even think about the possibility of doing anything with Amazon Web Services or the cloud. So if you'd asked me the chances that while he was building up the retail operation, that he would also be doing something that was disrupting the tech industry, that would have been a very, very long shot for me. And I've really underestimated the brilliance of the execution. I mean, it's one thing to dream about doing this stuff online, but it takes a lot of ability. And you can read his 1997 annual report, and he laid out a roadmap, and he's done it in spades. And if you haven't seen his interview on Charlie Rose 3 or 4 months ago, charlierose.com, go to and listen to it, because you'll learn a lot. At least I did. So I just plain, it always looked expensive, and I really never thought that he would be where he is today. I thought he was really brilliant, but I did not think he would be where he is today when I looked at it 3, 5, 8, 12 years ago, whenever it may have been. Charlie, how did you miss it?
It was easy. What was done there was very difficult, and it was not at all obvious that it was all going to work as well as it did. I don't feel any regret about missing out on the achievements of Amazon, but other things were easier, and I think we screwed up a little.
No. We won't pursue that line.
Well, I meant Google.
Well, we missed a lot of things.
Yes.
We missed a lot of things.
And we'll keep doing it.
Yeah.
I'm Adam Bergman with Sterling Capital in Virginia Beach, Virginia. Earlier today, Mr. Munger commented on the valuation of China versus the U.S. market. My question for you is, are market cap to GDP and cyclically adjusted PE still valid ways to consider market valuation, and how do those influence Berkshire's investment decisions? Thank you.
Charlie, I think, I guess Charlie's overall value in China. I would say that both of the standards you mentioned are not paramount at all in our valuation of securities. It's harder. People are always looking for a formula. And there is an ultimate formula, but the trouble is you don't know what to stick in for the variables in it. But that's the value of anything being the present value of all the cash it's ever going to distribute. But the PE ratios, every number has some degree of meaning, means more sometimes than others. Evaluation of a business is it's not reducible to any formula where you can actually put in the variables perfectly. And both of the things that you mentioned get bandied around a lot. It's not that they're unimportant, but sometimes they can be very important. Sometimes they can be almost totally unimportant. It's just not quite as simple as having one or two formulas and then saying the market is undervalued or overvalued, or a company is undervalued or overvalued. The most important thing is future interest rates. And, and people frequently plug in the current interest rate saying that's the best they can do. After all, it does reflect a market's judgment. And, the 30-year bond should tell you what people who are willing to put out money for 30 years and have no risk of dollar gain or dollar loss at the end of the 30-year period, what better figure can you come up with? I'm not sure I can come up with a better figure, but that doesn't mean I want to use the current figure either. So I would say that I think Charlie's answer will be that he does not come up with China versus the U.S. market based on what you've mentioned as yardsticks. But now, Charlie, you tell him.
All I meant was that I said before that the first rule of fishing is to fish where the fish are, is that a good fisherman can find more fish in China if fish is the stock market. That's all I meant.
Yeah. I'm going to go back
it's
to
a happier hunting ground.
This doesn't really directly relate. I want to go back to one question that was mentioned earlier. I really think if you want to be a good evaluator of businesses, an investor, you really ought to figure out a way without too much personal damage to run a lousy business for a while. I think you learn a whole lot more about business by actually struggling with a terrible business for a couple of years than you learn by getting into a very good one where the business itself is so good that you can't mess it up. I don't know whether Charlie has a view on that or not, but it was a big part of our learning experience, and I think a bigger part in the sense than being involved with good businesses was actually being involved in some bad businesses and just seeing
how awful it was,
how awful it is, and how little you can do about it, and how IQ does not solve the problem, and a whole bunch of things. It's a useful experience, but I wouldn't advise too much of it. What do you think so, Charlie? Here, yeah.
It was very useful to us. There's nothing like personal, painful experience if you want to learn. And we certainly had our share of it.
Okay, Becky.
My name is Sally Burns. I'm from Australia, but I currently reside in Austin, Texas. My question, Mr. Buffett, I have heard that Mr. Munger says your greatest talent is that you're a learning machine, that you never stop updating your views. What are the most interesting things you've learned over the last few years?
Well, it is fun to learn. I would say Charlie is much more of a learning machine than I am. I'm a specialized one, and and he does as well as I do in my specialty, and then he's got a much more general absorption rate than I have about what's going on in the world. But it's a world that gets more fascinating all the time, and a lot of fun can occur when you learn you were wrong on something. That's when you really learn that the old ideas really weren't so correct, and you have to adapt a new ones, and that, of course, is difficult. I don't know that I would pick out. Well, I think actually what's going on, in America is terribly, terribly interesting. And politically, all kinds of things, but just the way the world's unfolding. It's moving fast. I do enjoy trying, to figure out not only what's going to happen, but what's even happening now. But I don't think I've got any special insights that would be useful to you. But maybe Charlie does.
Well, I think buying the Apple stock is a good sign in Warren. And now he did run around Omaha and ask if he could take his grandchildren's tablets away. And I mean, he did market research. And I do think we keep learning. And more important, we don't unlearn the old tricks. And that is really important. You look at the people who try and solve their problems by printing money and lying and so forth. take Puerto Rico. Who would have guessed that a territory of the United States would be in bankruptcy? Well, I would have predicted it because they behave like idiots.
And we did not buy any Puerto Rico bonds.
No. And if you go to Europe, you go to Europe, you look at the government bond portfolios we're required to hold in Europe. There's not only no Greek bonds, they're the bonds of nobody but Germany. Just everywhere you look in Berkshire, somebody is being sensible. And that is a great pleasure. And to combine that with being very opportunistic so that when something comes along, like a panic, it's like playing with two hands instead of one in a game that requires two hands. It helps to have a fair-sized repertoire. And, Warren, we've learned so damn much. There are all kinds of things we've done in the last 10 years we would not have done 20 years ago.
Yeah, that's true. Although, if you take, it's interesting. I've mentioned this before, but one of the best books on investment was written, I think in 1958. I think I read it around 1960, by Phil Fisher, called "Common Stocks and Uncommon Profits." And
all the companies went to hell eventually.
But it talked about the importance, or the usefulness of what he called the scuttlebutt method. And that was something I didn't learn from Graham, but every now and then it's turned out to be very useful. Now, it doesn't solve everything, and there's a whole lot of more aspects.
I saw you do it with American Express and the salad oil scandal.
Yeah.
You're still doing it on Apple, decades later.
Yeah, in certain cases, you actually can learn a lot just by asking a lot of questions. And I give Phil Fisher credit. That book goes back a lot of years, but as Charlie said, some of the companies he picked as winners forever did sort of peter out on him. But the basic idea, you can learn a lot of things just by asking in some cases. I used to, if I got interested in the coal industry, just say, to pick one out of the air, when I was much younger, more energetic, if I went and talked to the heads of 10 coal companies, and I asked each one of them way later into the conversation after they got feeling very, it felt like talking, and I would just, I'd just say, if you had to go away for 10 years on a desert island and you had to put all of your family's money into one of your competitors, which one would it be and why? And then, then I'd ask them if they had to sell short one of their competitors for 10 years, all their family money, why? And everybody loves talking about their competitors. And if you do that with 10 different companies, you'll probably have a better fix on the economics of the coal industry than any one of those individuals has. There's ways of getting at things, and sometimes they're useful, sometimes they're not. But sometimes they can be very useful. And the idea of just learning more all the time about, I'm more specialized in that by far than Charlie. He wants to learn about everything, and I just want to learn about something that will help Berkshire. But it's a very useful attitude toward the world. And of course, I don't know who said it, but somebody said the problem is not in getting the new ideas, but shedding the old ones. And there's a lot of truth to that.
We would never have bought ISCAR if it had come along 10 years earlier. We would never have bought Precision Castparts if it had come along 10 years earlier. We are learning, and my God, we're still learning.
Good afternoon, Warren, Charlie, John, Norwood from West Des Moines, Iowa. You guys have iron bladders.
We won't tell you the secret of that.
I was wondering about a contraption under the table there.
No. You can come down and inspect.
All right. Hey, I had a question for each. Warren, I was fortunate to ask you a question, I think in 2011, about legacy and what you wanted to be known for 100 years from now. And I'm kind of curious to hear what Charlie would like to be known for. And then, Warren, I'm 52, so I guess you started doing this when I was born. And I'm kind of interested in a memory from your first annual meeting.
My first Remember when Warren got on this subject and they asked him what he wanted said at his funeral? He said, I want them to all be saying that's the oldest looking corpse I ever saw. and
that may be the smartest thing I ever said. No, well, with me, very simple. I really like teaching, so basically that I've been doing it formally and you can say somewhat informally all my life, and I certainly had the greatest teachers you can imagine. So if somebody thought that I did a decent job at teaching, I'd feel very good about that.
Yeah, to make the teaching endurable, it has to have a bit of wiseassery in it. And that we've both been able to supply.
And for those of you who are old-time basketball fans, I might mention that on Wilt Chamberlain's tomb it was reputed that it was going to say, "At last I sleep alone." Okay, station 9.
Good afternoon, Mr. Mang and Mr. Buffett. My name is Ji Wenyan, and I'm come from China. It's my first time to come to this meeting, and I think I'm very lucky to have a chance to ask questions.
We're glad to have you.
Thank you. And everyone has personal dreams, and at different ages, maybe dreams will come differently. And what's your dream now?
Charlie, we'll let you go.
I didn't quite hear that.
Well, what's your dream now? She says,
my dream. Well,
let's skip the first one.
sometime when I'm especially wishful, I think, oh, to be 90 again. And I got some advice for the young. If you've got anything you really want to do, don't wait till you're 93.
No, do it. No, that's the same thing I would tell students, is that you can't always find it the first time or the second time, but when you go out in the world, look for the job that you would take if you didn't need a job. I mean, don't postpone that sort of thing. Somebody, I think it was Kierkegaard, said that, life must be evaluated backwards, but it must be lived forwards. And you want to sort of, Charlie says all he wants to know is where he'll die, so he'll never go there. And so you do want to do a certain amount of reverse engineering in life. I mean, that doesn't mean you can do everything that way, but you really want to think about what will make you feel good when you get older about your life, and you at least generally want to keep going in that direction. And you need some luck in life, and you got to accept some bad things that are going to happen as you go along. But life has been awfully good to me and Charlie, so we have no complaints.
What you don't want to be is like the man, and they held his funeral, and the minister said, now it's the time for somebody to say something nice about the deceased. And nobody came forward. He says, surely somebody can say something nice about the deceased. And nobody came forward. And finally one man came up and he said, his brother was worse.
Yeah.
My name is Andy Li Junling from Royal Valley Innovation Capital from Shanghai. This is my 6th year from Shanghai to here. I have to say to you too, Warren and Charlie, you are highly respected and deeply loved by millions and millions or even billions globally. I have 2 questions today. First question, in your letters to shareholders, you said you believe EBITDA is not a good parameter to value a business. Why is that? Can you elaborate on that? Second question, you both have very successful and happy lives. With great respect, my question is to each of you. In retrospect, from a personal standpoint, do you have regrets in life? If there is one thing you would have done differently in your life, family, personal, or business, what is it? Thank you very much.
Yeah, I don't think you should expect us to answer that on personal, but if in business, I would say I wish I'd met Charlie earlier. We've had a lot of fun ever since I was 29 and he was 35, but it would have been even more fun if we'd started many years earlier. We had a chance to. We worked in the same grocery store, but not at the same time. In respect to EBITDA, depreciation is an expense, and it's the worst kind of an expense. You know, we love to talk about float, and float is where we get the money first and we have the expense later. Depreciation is where you spend the money first, you know, and then record the expense later. And it's reverse float, and it's not a good thing. And to have that enter into a multiple, it's much better to buy a business that has, everything else being equal, has no depreciation, because it has essentially no investment in fixed assets and makes X, than it is to buy a company that where there's a lot of depreciation in getting to X. And I may write a little bit more on that next year, just because it's such a mass delusion. And of course, it's in the interest of Wall Street enormously to focus on something called EBITDA, because it results in higher borrowing power, higher valuations, and all of that sort of thing. So it's become very popular in the last 20 years. But it's a very misleading statistic, and be used in very pernicious ways. Charlie, on either one of those subjects?
I think you've understated the horrors of the subject and the disgusting nature of the people that brought that term into the valuation of business. It would be like a leasing broker of real estate you had 1,000 square foot new suite to be leased, and he says it's got 2,000 feet in it. That's not honorable behavior, and that's the way that term got into common usage. Nobody in his right mind would think that depreciation is not an expense.
Yeah, but it's very much in the interest of Wall Street.
Yes, that's why they did it.
Yeah.
It made the multiple seem lower.
And what's amazing is the way it's accepted, actually. But anyway, it just illustrates how people use language, you know, and sell concepts that work to their own use. And 2 and 20 has the same sort of thing. I mean, the number of people, the amount of money that's overperformed after paying 2 and 20 compared to the expenses that have been incurred, I will assure you, makes for a terrible indictment of that particular arrangement. But as long as it can get sold, it will get sold. And
now they use it in the business schools. Now that is horror squared. I mean, it's bad enough that a bunch of thieves start using a term, but when it gets so common that the business schools copy it, that's not a good result.